Hello and good day to you. So today we're talking about stocks. On this particular sheet in front of you, you'll be looking at an Apple stock. It's downloaded from the get symbols function, which is part of the quant mod library, which you can bring into your R and play around with. The great thing about this is you literally just type get symbol, put in the symbol of the particular stock, which you'll have to Google if you're not sure which, and look and add in the source that you want to get from. I'm using our Yahoo financial information. I do think Google's available, and maybe a few others, but if you want to look into that, please do. Now, as previously stated, I'm not a financial analyst. Do not take this as financial advice. We're just interested in the statistics and methods that you might use for analysing stock to learn a little bit more for at least my own learning, and if you're following along, hopefully for your own enjoyment. Now, the first thing to think about with stocks is this is about creating a position. Now, I played around building a genetic algorithm and didn't get that far with it for time series analysis. And the reason that it's faulty to think of stocks as purely an analytics process is there is a huge amount of human error involved. And actually, you need to think of it in terms of your position. You have an expectation or a strategy for this buy that they talk about as a position. Now, you buy a stock, you have a position. There's only two ways it can go. It can either go up or down. So you can only ever be expecting to buy a stock to play a long game, and a long game is it increasing in value forever and ever and ever, and one day you sell it and make a load of money off it, and that's a long, because that's hopefully the plan is a long-term investment. Now, a short is much riskier in theory, because what you're doing is you're selling the stock, hoping that then the stock value falls to buy it at a cheaper price, to have then made a load of money from the stock devaluing, and end up with a little bit of money and still have the stock which you still own. Now, you create these strategies, and these strategies will include things like, I will not have more than 10% of my portfolio in any one stock. Any stock that loses a value of 20% we will sell, things like that. Other strategies involve trading signals. Now, trading signals are all about these moving average lines. The two you can see is the pink and the blue. The blue is the slow moving one, where it tracks more the volatility day to day, and the pink is the slow moving one. Now, when the slow moving passes the fast moving blue one, that's what they call a trading signal, and it's a signal that might cause you to make a sale or make a buy. Now, if you think about it like this, when this pink line crosses the blue here, that would be a really good wet place to short that stock, and sell it, because it's going down in value. When the opposite is true, when this crosses back over, you could see a good point to buy that stock because it's trending to go back up. Likewise, you can see another case here where they swap places. So you can see, if you followed perfectly this sort of swap over point from point, you might not make the hugest amount of money in the world, but you'd probably, you'd have shorted it there, bought it back at the same value, and you can see where the strategy comes of selecting how much before, as in to make the most money, you need to be ever earlier in this sort of lull before you see the crossover, the trading signals. But if you were too late, you make a loss. So you can see here, trading signal to sell, you sold. If you bought back in there, you'd make money. If you bought back in there because you were late on the signal, you'd lose money. So that's the general theory that we're talking about for trades. Now, I want to show you the candlestick chart, which this is going to be named after as the video. And you can get data as a vector like this, just choosing the individual point. You can also do this and filter the data that way. They're not quite normal tables for R, so do it this way. Don't try using filters from the DPLYR setup. As we can see, if I go and look into a much smaller scale candlestick chart, which is just for 2020, you can then see the red and black lines, and the red lines are bad trading days where a stock lost money, and the black lines are where the stock gains money. You can see the volume down here below, which I haven't quite got into in my head round the exact trading methods. There you can see there is a tendency of big changes in the stock correlating to big trading days, so you can see almost instantaneously why that would be important to look at and understand a little bit. Now, this isn't going to quite work for the 200 days because there is literally 200 days in this. But you can see here, when a bit closer, you've got your 20-day fast-moving value, and you've got your 50-day. Now, when your different moving averages swap over, that's a danger sign for you to consider changing your strategy, and depending on your position for the stock, might mean that if you were doing this properly and professionally, you'll have written up a plan for that stock and a position for it that explains how you're going to trade it. Now, I hope to do a little bit more on stock positions moving forward. I feel that I will really want to understand trends properly and understand methods of analysing trends before I do something crazy like look at vector autoregression, because I just think it's hard, and when you actually read even a little bit of vector autoregression, you sort of realise it's not used as much as just basic ARIMA and basic moving averages. So it feels more important to learn this than go on to harder stuff. So yeah, that's hopefully a really simple introduction to candlestick charts, and a simple introduction of how to use moving averages with them for stock analysis. I had to do this because I was looking at building a genetic algorithm that didn't work out. It turns out that if you pass through thousands of different models, you are very likely to find one or two that are really accurate, and when you do that for certain stocks, that was great. I also found that you hit on certain stocks where there just was no trend. It was a changing market where it was either going up or down quite violently, or even worse, it was just not going anywhere, and the genetic algorithm wouldn't find anything, wouldn't find any trend, and would spit out rubbish. And this made me sit there and realise I didn't really know what I was doing, that I was just assuming that the best way of doing this was to create a forecast of future value and move off there. It turns out the stock trading malarkey and this technical analysis is much more complicated. And by the way, I've used the phrase technical analysis. It's technical trading analysis for it. This is this candlestick chart. is the basic technical analysis that you can do for stocks. So, hey, if you manage to do this and manage to keep up, you are pretty good at stocks already. Though, please remember previous warnings of if you are going to try this at home, take it on your own head and do your own analysis and read a few books before doing it. Anyway, that's all for me. That's my blog post for R and statistics. Thank you. Have a good day. Bye.